Let's continue our discussion about problems with the stabilization policies. Here in this video, we're gonna focus upon the problems with monetary policies. Okay, and the first and probably the most important problem here, or most common issue with the monetary policy is uh, the Fed's control over money supply, which we discussed back in chapter 4. Okay, and back then we introduced a model of money supply. I'm not sure if you guys still remember that. So what we're saying is uh, what the Fed could control in reality is just the monetary base. Okay. Um, However, what actually affects the economy is money supply. Okay. And the difference between these two would be the money multiplier, right? So we're saying that money supply equals monetary base times money multiplier, right? And that model tells us that the Fed has no 100% control over money supply. All right. So what actually happens on the ground is like this: when the Federal Reserve, realized that it needs to conduct the expansionary monetary policy, they're gonna, um, you know, invent the new money in their computerized or electronic system. Okay. In these days, everything becomes, um, electronic or computerized. So the Fed does not need to physically print um, the new money. Okay, they only need to, create these numbers in their computers. Okay. Now, once they invented the new money in their computers or in their system, they need to pump the money into the economy, right? How could they do that? The Fed is going to uh, buy the financial assets on the market with the newly invented money. Okay. Now, most likely, the Fed is going to buy the treasury bonds or mortgage-backed securities from financial institutions. Okay. Um, so after these transactions, then the Fed is going to hold the treasury bonds or mortgage-backed securities, and these financial institutions would hold the newly invented money, okay, by the Fed. Now, in the ideal world, the Fed expects these financial institutions uh, to lend out or loan out these newly invented money, okay, to households who need to buy, houses, for example, or big items, okay, or they could lend the money to the private businesses so that they can invest. Okay, that's how these newly invented money would eventually affect the economy or boost the economy. Okay, however, in a realistic world, those banks, when they received this huge amount of money newly invented by the Fed, they turn around and go to the market. They oftentimes find, there are not enough qualified borrowers. Now, here, qualified borrowers means those borrowers, no matter it's the households or the firms, they should have a decent credit history, right? In other words, the bank would expect them to pay back what they borrowed in a few years, um, or after a certain period of time. Okay. The second thing is they gotta have a reasonable, uh, the project, okay, to, to justify their borrowing. For example, the firm got to have the profitable project, right? Like, you have a pretty cool idea, or you want to produce new products, or you probably, get a construction contract from the government. You want to build something for the government, right? You have to have the reason to be able to borrow from the bank. So remember, the Fed invented this huge amount of money right after the recession, right? Or even during the recession. Um, that During that period of time, these banks, they often have a hard time finding these borrowers on the market. Okay, so what we find is eventually, a huge amount of the newly printed money or newly invented money end up sitting in bank offices. Okay, so again, here what we're saying is how much banks reserve is key, but unfortunately out of the Fed's control. Okay, the Fed cannot force the banks to lend out the money. Okay, so some people would say, these excess reserve could be a time bomb during the post-recession era. Okay. Now, excess reserves means the reserves the bank holds above its reserve requirement. Okay. In other words, if a bank, let's say Regions, is required to hold 4% of its deposit as to meet the requirement, but right after the recession, um, when Regions sold huge amount of the treasury bonds or mortgage-backed securities to the Fed and received a lot of money, newly invented one, from the Fed, um, they could reserve, let's say, 10%. Okay? In other words, way above its required level. Okay? So this is so-called excess reserve. Okay? Now, when the financial institutions hold the excess reserves, they could lend the money out in the future, right? But the timing or the amount, specific amount they lend out, is totally out of the Fed's control. That's why some people would call it a time bomb, okay? Because it could, make the economy, as we said, overheated later, okay? Now here is a Fed chart to show you how large the bank reserve is. Okay, so this is a total bank reserves of the depository institutions. Okay, now it shows from the year 2000 to the most recent period. Okay, as you can see that right after the 07-08 financial crisis, because of the three phases of QE, the bank reserves increased a lot, okay, all the way up to like 2.8. If I remember this correctly, $2.8 trillion, okay, actually sitting in their offices. Now here we're talking about 2014, so that was about 5 years after the recession. Okay, we still have that much money um, in the banking system. Okay, now when they start lending out again, it could make the economy overheated. Okay, now as you can see, right before the pandemic, the banks in the U.S. Did lend out a substantial portion of it, so the bank reserves fell below like approximately 1.6 trillion dollars. Okay, and then here comes the pandemic. Okay, so the Fed did it again. Invented a lot of money, so the bank reserves shoots up from approximately 1.6 trillion all the way up to more than $4 trillion. Okay, again, what are they going to do with this? Okay, that could become a concern. Okay, now another issue here is something similar to what we discussed before. So oftentimes we find that the expansionary monetary policy would take somewhere between 12 and 18 months to really affect the economy. Okay, so that lagged effect is something the policymakers always need to keep in mind. Okay. And the third issue we're talking about here is anticipate the economic situation a year ahead. Now, remember, because the effect will take approximately 12 to 18 months to really affect the economy, right? So when we come up with the policies, we want to be a year ahead, right? Well, in other words, when we look at these macroeconomic indicators, we have to, or the policymakers or the economists need to predict what these indicators will be in a year, okay, so that we can make the right decision today. Okay, now this is going to be super tricky. Okay, here we're going to show you a very interesting survey economists did. Okay, so here the vertical axis is the unemployment rate. Horizontal axis we look at from 1980 to 1986. Okay, the red curve is the actual unemployment report. Okay, I'm sorry, unemployment rate. Okay, which was reported by government. Okay. You also see, at some points you find this green line with some white dots along it, right? Now let me show you, or let me talk about, what they mean here. So this one, for example, this represents the year 1981, the fourth quarter. That's why you see this label here, okay? Year 1981, fourth quarter. Now, at that quarter, they asked a group of economists to predict the unemployment rate in the next 5 quarters. Okay, so here is the fourth quarter of 81. This is going to be the first quarter of 82, second quarter, third quarter, fourth quarter of 82, and then the first quarter of 83. Okay, and in other words, what you find here is when the unemployment rate took off, in other words, when the economy steps into the recession, the professional economists tend to underestimate the situation. Okay, underestimate the negative influence of the recession. For example, here, the economists believe that the first quarter of 83, the unemployment rate should fall back to approximately 8.5%, right? But during the same quarter, if you go up there, you would find that the actual unemployment rate was above 10.5%. Okay, so professional economists seriously underestimate the unemployment rate. Okay. What's also equally interesting is when we stay on this side, when the situation gets better, so the unemployment rate declined, we find that the professional economists overestimate the unemployment rate. Okay. For example, here we're looking at the second quarter of 83, right? So based upon the estimation, so this is going to be the third quarter, fourth quarter, in the first quarter of 84, second, third quarter of 1984. The economists believe the unemployment rate should be somewhere around 8.6%, 8.7%, right? But the actual unemployment rate reported by the government in that quarter is 7.5%, much lower than the estimated one, right? Once again, the point here is, the accurate estimation is very hard. Okay, so here I would like to leave this for you guys to think about. How would the experts' inaccurate estimation affects the policies made on the basis of this estimation? Okay, so if the estimation itself is not accurate, what kind of the policies they tend to make? And how would these policies affect the stabilization of the macro economy? Okay? Again, bring your thoughts to our class to discuss.